Hello and welcome to UOB Private Bank's podcast series, and we are going to talk about stagflation and the misery index today. My name is Francis Tan. I'm the investment strategist from UOB Private Bank. Now, if you recall from our last podcast, we talked about the US inflation expectations remaining high over the next 1 year at around 6.6%. With that, in the latest May FOMC, the Fed hiked the interest rate by 50 basis points, mainly to fight the higher inflation expectations going forward. Now, going forward, I'm expecting the Fed to come up with more 50 basis point rate hike in each of the upcoming meetings. Now, over the past couple of months, the high inflation around the world with lower economic growth brought about stagflationary concerns. Now, the word stagflation came from a period of high inflation while low GDP or economic growth. Now, across the news agencies around the world, the keyword stagflation came up very, very frequently. Now, even if I look at Google Trends or Google search of the word stagflation over the past 5 years, that really peaked in March 2022, although the word search for stagflation has come down quite significantly since then because of a little bit of reduced concern of the inflationary numbers that's going to come up. Now, what really is stagflation? Yes, I just mentioned that stagflation means a period of high inflation and low economic growth. But to put a correct definition to a more accurate definition to it, we must see that the period of inflation should be persistent for a couple of years, in fact, just like what we saw globally in the late 70s. Now, for GDP growth, it has got to be low or, in fact, negative GDP growth. That means recessionary conditions, a rising unemployment rate, recession in most of the global economies, and at the same time, poor implementation of government policies. But today, we are not seeing all these things happening at all. In fact, if you look at one of the metric, unemployment rate, many countries in the world today are having very low unemployment rate because of the economic reopening from the pandemic. So another interesting concept I want to introduce to you is the misery index. Now, that is based off stagflation. It's very much similar to stagflation. Recall what I mentioned just now. Stagflation is a period of very high unemployment rate, right? And also high inflation rate. If you add the two numbers together, the higher the number means for the country, the population, the people are a lot more miserable. Now, what is the country in the world that is least miserable today? It's actually Japan. Now, the unemployment of 2.6% and inflation rate of 1.2% in Japan gives Japan a misery rate of only around 3.8%. Now, if you look at many other countries such as China, Malaysia, Singapore, Indonesia, and even Turkey, Turkey is at 71.8. That is one of the most miserable country in the world because they have very high unemployment rate and very high inflation rate as well. Now, those were for 6 countries. If I put them on the scatter plot here, most of the countries you can see from this plot is clustered towards the lower left-hand side of this scatter plot. It means that most of the countries in the world today are not very miserable. They are not in the stagflationary environment. They are seeing pretty low levels of unemployment rate and manageable inflation rate. But that is not true because the world is uneven. That's not true for many other countries such as South Africa, which is at the top, and Argentina and Turkey. So while generally most of the countries in the world are not in a stagflationary condition, some countries are already having stagflation. And of course, we have been hearing from governments and news agencies about inflation. The inflation usually concerns that they report is about consumer prices because that affects the common man on the streets. However, we must not miss out the other part of the equation. We must also look at asset inflation, asset prices. On the left-hand side, we do see a plot of consumer inflation in the US versus asset inflation. Now, since the global financial crisis from 2008 and 2009 till today, US inflation, which is consumer inflation, rose at around 1.9% per annum. However, if you look at asset prices, if you would have invested in the S&P 500 index, you will have seen your assets growing at around 14% per annum, way outstripping the rise in consumer prices. On the right-hand side, we do see a similar trend in Singapore, whereby asset prices rise faster than consumer prices. So what this goes to show is that it's important for us to remain invested in assets. It's always, in the long run, on an average basis, outstripping the growth in consumer prices. So in summary today, inflation expectations will remain high over the coming year. That's true. Central banks such as the Federal Reserve will continue to be hiking interest rate quite aggressively just to tame the inflation. The high periods of inflation has brought about concerns of stagflation, which I explained is a period of high and persistent inflation with low sustained economic growth. Now, that's not true because most of the countries in the world are not going to see this persistent inflation. And certainly that means that we are not in a stagflationary environment at all. So we also introduced a very similar concept to measure stagflation, which we call it the misery index. Though the world is not in stagflation, some of the economies are. And while inflation is high, it is a cyclical phenomenon. The long-term average consumer inflation trend will still be lower than asset inflation. As such, always stay invested in assets in order to maintain a strong future purchasing power. So thank you for tuning in to this episode of UOB Private Bank's podcast on stagflation and the misery index. Do stay tuned to more exciting content coming up. Thank you.